So I think it's safe to say that everybody knows what PMI is, private mortgage insurance. It basically just means that if you're buying a home and you don't put 20% down, then you are going to have to pay this insurance until you have 20% equity built into the home. But what you don't realize is that there are ways that you can slowly get out of it, and there are some dirty things that I want to talk about in this video because you just need to understand PMI a little bit more. The first thing you should know about PMI is that a lot of the time it works in tiers based on how they're charging you every single month. So if you put less down on the home, you're going to have to pay more in PMI every single month. So if the tiers were 0 to 5%, 5 to 10, 10 to 15, and 15 to 20, well, if you had 14% down on your house and that was going to put you in the lower tier, if you could just find a little bit more money and bump you up into the 15% range, then you would pay less in PMI, and that is a really good thing to know if your PMI works on tiers. So if the insurance does work in tiers and you are close to hitting the next level, then definitely do it because you want to get locked in at the lowest monthly rate that you can, because going forward you are going to have to pay that rate until you meet the next criteria to get out of PMI. And you should also know that a lot of PMI contracts out there have a 2-year lock-in period, meaning you can't wiggle out of PMI even if you come up with the money. So you really want to focus on getting the lowest rate possible right from the beginning, especially if you're going to be locked into the stupid thing for 2 years. I personally feel like a 2-year lock is pretty dirty, but if that's what the contract states and you signed it, then that's what you have to deal with. Now, I also want you to know that as long as you're paying your mortgage every single month, eventually your PMI is going to go away automatically. And this is a good thing because a lot of people out there, they'll just continue paying their PMI forever because they're not paying any attention and they have no idea that they have more than 20% equity in their home. But because this is a law, I don't know if this applies in every single state, but I really hope it does. The law says that you will get out of PMI as soon as you hit 22% automatically according to the original amortization schedule on your mortgage. So as long as you follow that original schedule, usually about 5 to 7 years after you've been paying on a 30-year mortgage, you are going to get out of PMI because it's going to hit more than 22% loan to value. It is a good thing that the PMI will automatically go away at 22% for all the people that don't pay attention, but for the people that do pay attention, you don't have to legally have PMI once you hit the 20% mark. So a lot of the time on a 30-year mortgage, the gap between 20% and 22% is usually about 1 to 3 years. And so if you're paying PMI for 1 to 3 years on your mortgage past when you legally don't have to, then you really should be getting out of it. Now, what you need to do is just pay attention to exactly where that 20% mark is, and then find out on your contract exactly how to get out of PMI at that point instead of relying on it automatically shutting off at 22%. So if your house was originally $300,000 and you started the loan at $260,000, well, you're going to know that $240,000 is the 20% mark. So you just need to look through your schedule, look at all the different years as you make normal payments, and you're eventually going to hit $240,000. Once that date is set, that's the date that you need to put in your calendar so that you can reach out to the insurance company and get rid of your PMI. And then I also want you to know that you can get out of PMI quite a bit early if your house increases a lot in value. Because if your house increases enough, a lot of the time you're automatically going to be over that 20% mark just because of the increase in value. Now, a lot of the time you are going to have to get an official appraisal, so that could cost you about $300 to $500. But if it states in your contract that you can do that, then go ahead and pay that $500 because that might just be worth the savings in PMI over a short period of time. And you can also get out of PMI if you refinance your house and the new loan to value is over 20%. So obviously, if the housing market keeps going up, then it's going to be really easy for most people to get out of PMI, but you just have to pay attention to your contract and get out as soon as you legally can. Now, if the market happens to go down, that's another story because things are going to work in the opposite sense, and you're probably going to have PMI for a lot longer than you'd like to. But if the market continues going up, just pay attention to that contract and you can save quite a bit of money on your premiums just by getting out as soon as you legally can.